I'm Angela Chompus. I'm the Director of Marketing for Rapport Credit Union. Thank you again for joining us today. Our presenter is Michael Trklja, Certified Financial Planner from our Rapport Wealth team, who will be presenting today's webinar. We will be taking questions at the end, so feel free to use the chat or Q&A function depending on your setup. And I'll hand it off to Michael. Michael?
Thank you, Angela, and good afternoon, everybody. I hope this presentation finds you well wherever you're tuning in from. Certainly is fall down here in downtown Toronto. You know, as soon as we hit the 21st, everything turned gray and rainy. So, but with fall also comes historically uncertainty in the markets, and that's what we're going to talk about today. Because the markets, you know, over the last little while have been volatile. And certainly it doesn't look like there's any chance that that's going to change and go away anytime soon. So what we wanted to present to you today as clients of members of Rapport is to really look and see, okay, how can I best deal with this volatility going forward and give you some strategies going forward with that. So with that, let's look into the presentation today. First of all, for those of you who may have forgotten or maybe guests who aren't members of Rapport and are participating on this call, who are we? Well, we're a financial cooperative. We're a credit union owned by its members. Initially, we're the amalgamation of two credit unions with a history of spanning over 75 years. So we've been around for a long time. And as I said, we're a cooperative owned by its members. So you are the shareholders. Many people deal with other financial institutions who are maybe publicly traded like the banks. The shareholders may not even bank with that institution and do their financial services with that institution. But in this case, you are our shareholders. We offer full service banking in both in person and online, and they are on par, if not better than anything else that's available out there. And probably our best kept secret is the complete wealth advisory and financial planning that we offer. 3 members of our financial planning team are certified financial planners. And certainly we have the wealth and breadth of experience that we can collectively that we can help you with any financial situation that you may be facing. And our background really is, you know, while a lot of our members are government employees, both current and retired, and their family members, we're also open to dealing with the members, with the community at large. So whether you're in the Greater Toronto area where I'm speaking from this afternoon, or you're maybe up in Thunder Bay or North Bay or Sudbury or whatever, or Kingston, or wherever that might be, that's certainly we're certainly happy to help you out, whatever your financial situation is. So what's been going on in the world recently? You know, what's caused all this volatility, right? So we've looked at a number of things, and, you know, what's been going on. We've had coronavirus, which certainly was a huge impact over the last 2 years. A lot of places were shut down, both not just in Canada, but also globally as well. Some jurisdictions in the world are still experiencing a fair degree of coronavirus impact on their economies. And once we started getting out of that, just to make life a little bit more interesting, the war in Ukraine started. And that's basically been the first war on European soil since the end of the Second World War. And really, that is still going on as we speak, and hopefully that will end sooner rather than later. Once the war in Ukraine started, and you know, there was pressure on Russia, which is one of the largest oil and gas producers in the world, we saw the price of the gas pumps go up to levels that we have never seen before. That picture there actually is showing peak gas prices. And although they've thankfully come down quite a bit, that really worked into the economy as a large, and we're looking at, and the cost of everything went up. So groceries, anything that you can think of, if anyone out there has been going grocery shopping over the last few months, they've seen the price of some of the staples that they generally have been buying for years go up exponentially. So, you know, we've really seen a lot of, you know, inflation in the market. And with inflation comes in the Bank of Canada, because the Bank of Canada tries to control the inflation rate and doesn't want to have too much inflation in an economy. So what we've seen is an increase in interest rates. And really, since the end of last year and certainly since the beginning of this year, we've seen interest rates that we haven't seen in an awful long time, certainly in the last 15 years for sure. Now, with an increase in interest rates and all the other uncertainty out there, we see more volatile markets that have happened too as well. And that volatility makes a lot of people concerned about not just their investments, but also other things, their jobs and their plans on whatever they're doing for their day-to-day life, whether they're looking at refinancing some debt, purchasing a new house, selling a house, retiring. It's all connected, and that's made a lot of people concerned. And what's happened with that increased volatility is we've seen housing prices plummet, for lack of a better word, since the peak of February of this year. In this part of Ontario, housing prices have dropped approximately about 30% from the peak that we saw in February of this year. And in other jurisdictions out there in areas within Ontario, housing prices have dropped significantly too as well. Maybe not as much, but still it's a reality that a lot of people are looking at. And then with all of that, with the death of the Queen 2 weeks ago, and since I actually did up this presentation, we've had another couple of instances, greater uncertainty. We've had an election of a right-wing president in a G7 country in Italy earlier this week. We've had the war in Ukraine escalate, if not, if rather than diminishing. As well, with more Russian draft going on. And we've even looked at today with some concerns out of the Bank of England going in and buying pound sterling bonds to support the pound, which has been plummeting. So with all that uncertainty in such a short period of time, investors are really, really emotionally invested in this market. They're really scared. And many of the conversations that we're having with clients right now and members, we're certainly having around that fear and that uncertainty. And the purpose of this presentation today is really to help with dealing with that uncertainty. And, if you look at, the uncertainty itself, there's a financial graph that's been out there for a number of years, which is the emotional roller coaster of investing. When everything is going well and you see everyone's optimistic and excited and they're thrilled because everything is going up. And as Warren Buffett once said, when the tide rises, when the tide goes up, all boats rise. There's a lot of euphoria in the market. And some people start to believe that really whatever they invest in, they're really smart and they really know what they're doing. And that's not to say that people, are owing over their heads, but they forget that the markets do go down too as well. So when the markets initially starts going down, there's a little anxiety, which is where we are right now, approximately, if we're looking at those two red dots. And a lot of people are saying, well, this is only temporary. I'm a long-term investor. This is going to wash out. And then the inevitable happens. There's, denial that the market is still going down. There's more fear, there's desperation, there's panic. And finally, there's capitulation where people say, how could I have been so wrong? I must have made a huge mistake. I'm never doing this again. And this is the point where we as advisors get calls from clients with all these emotions. And they're basically saying, you know what, get me out, just put me in a GIC. I can't take this anymore. And then what happens is that's really at the point of maximum financial opportunity. So they're really doing things, they're getting their timing off here. And then, there's a little bit of depression there saying, geez, I lost so much money in the market, but then they see the markets going up again and there's hope, relief, and optimism. And this whole cycle continues over and over again. So what we're trying to do in this presentation today is to get you off that emotional roller coaster. It doesn't have to be that way. And we want to get you more more constant in your emotions. And there's ways to do that, to minimize your risk, to reduce volatility to your portfolio, and most importantly, to get to where you want to be. So whether that investing is for rainy day funds, whether that investing is for retirement, for a child's or grandchild's education, or whatever goal that you may have, we want to make sure that you feel confident and comfortable that you're going to get there in the best way possible. So earlier on, I said, people are looking at that point where they're saying, interest rates have gone up, the markets are real shaky. Maybe I should just kind of get out now before it gets worse. And again, one has to look at what the reality is out there. So, if we look at this example here, where somebody's invested $1,000 and they're in a tax bracket, which is about 29%. So that's somebody who's making roughly around $65,000 a year. And I put a modest amount of inflation there at 4%. Inflation right now in Canada, as of August, which are the latest numbers out at this point, is 7%. So, even at the various rates of return out there, there's going to be things that are going to be eating away at your investments. At 2%, you're going to make $20 on that $1,000. At $40, $60, or $80, depending on your interest rate, but you're going to have to pay tax. And the tax is all going to be, depending on how much income you make. So with the deduction of your after-tax returns, you're still going to be in the positive number. But what people don't see, and what people forget about in many cases, is what inflation is going to do. Your purchasing power, if inflation is 4%, your purchasing power is going to decrease by 4% year over year. You're just going to be able to, you're not going to be able to buy as much as you could with that dollar this time next year as you're buying right now. So after taxes and inflation, you're going to see that really you're going to have to be earning at least a 6% rate of return on a 4% inflation rate to be staying ahead of the game. And with a 7% inflation rate, although we don't believe it's going to stay that high for a long period of time, the only thing you're probably not even going to be keeping your head above water on an 8% rate of return. So really, all you're doing is going into a guaranteed investment right now is you're guaranteed that you're going to lose money. And that's the only guarantee that you're going to get from that at this point. We've got some questions already. So what we'll do is we'll answer those questions at the end of the presentation, and we'll go through them. So don't stop putting in your questions in the chat, in the question and answer. We'll answer them at the end. What really comes down to investing, and whether one is investing in good markets or bad markets, is essentially what sort of income do you need in the future? And what are you looking to, and that comes from a number of factors. What we took here is an example of a typical member who's retiring at age 60 and has a pension, a defined benefit pension plan, and they're going to get their full pension because they're retiring at 30 years service. Inflation rate here, we've done a little bit lower at 3%, and their annual salary is at $75,000. So really their annual income need, they figured, is about $55,000 to age 85. And at age 85, maybe they're going to travel less, maybe they're going to be out and about a little less. They're going to cut back on their spending. And a lot of people look at this and say, well, 85, I'll be lucky if I get there. The reality is, once you reach the age of 60, from actuarial tables done in Canada, the fact that you have a 66% chance that you're going to make it to age 95. So we like to err on the side of caution for our members when we do financial plans. So we assume that they're going to make it there, because the last thing you want to do is run out of money when you're 87, because that's not going to be a great place to be. So if you look at this graph right now, you'll see the various sources of income. So the person is retiring at age 60, they're going to be getting their pension, and their pension is going to be bridged. So that means they're going to be getting their CPP or benefit within that pension plan itself. And once they reach age 65, they'll be getting their old age security, and they'll be getting their CPP benefit directly from the Canadian government rather than the bridge through their pension plan. And what you can see there is their income needs will always go up. And from there, in addition, there's also going to be what we see there, there's going to be a deficiency. And that starts really later on in retirement. Because if we look at it, the big thing here is taxes. So you got to keep your money ahead of taxes and ahead of inflation to maintain your purchasing power. So how does one do that? Well, the first thing you want to look at is risk. Now, there's all sorts of risks. You know, we had the risks that I outlined in the table, the geopolitical risks and the like. But risks basically boil down to 4 places for any investor out there, no matter how much they're investing and no matter for how long they're investing for. They come from the investments, their plan, the advisor, and the investor themselves. So so if you look at under that, I'll explain these very briefly. We have the markets, obviously. Credit refers to the bond markets. Market refers to stock markets. Interest rates are something in regard to, the Bank of Canada. Are they going to raise or lower interest rates? And currency risks too, as well. Many investors have investments outside of Canada, and those investments will be purchased in different currencies. So what is that currency going to look like against the Canadian dollar? We also have the plan. So about the individual income tax, what the income tax rates are going to be, what inflation is going to be, how much is going to eat into their purchasing power, their liquidity, how much liquidity they're going to have in their investments. GICs mature at a certain period of time, and you don't have much liquidity to them. Other investments have more liquidity. So what is that need for liquidity for that investor going forward? And longevity is what we spoke about earlier on, is how long those goals are expected to be in duration, or at what point they're going to be expected to draw on those investments as well. The other 2 sources of risk is the advisor. You want to certainly have somebody who's competent, who knows and has experience in the markets, so has gone through periods where the markets have and invested for clients successfully, where the markets have been in similar situations as they are right now. You also want objectivity. You want advisor is giving you, not just selling or recommending products that are proprietary, that belong to the company that they work for, but also going out there and finding the best product for you and to fulfill whatever investment needs that you have. And you also want to have somebody who's ethical too as well, that they're making decisions not based on how much they're making or some sales target that they have, but based on what's right for you. And certainly the last thing is the investor, yourself. How do you make your decisions within your household? Is it one person? Is it 2 people? Do you make decisions quickly, or do you like to study more and make a more informed decision? And what sort of discipline that you've put in place for yourself as an investor? So I've had one member once tell me I'm a disciplined investor. Every time I get my statements, I don't open them, because it just makes me afraid. But that's not the way to go. And certainly they have nothing to be afraid about. So, let's say you as an investor want to deal with these risks. Well, as you can probably recognize here, a lot of these risks are in your control. The first one, and the one that's closest to you, is the investor. How do you deal with these markets? What do you look at? What is your decision-making process? And in a lot of cases, that's something that we routinely help members with when we sit down with them and talk about their investing. And that's the purpose of this presentation too today. So, if we look at that, and the next thing is the advisor. You want to get somebody who's competent and objective and certainly ethical too as well. That's also in your control, and there's resources to do that, to shop around, to make sure you're comfortable with who you're working as an advisor, because this is a relationship that hopefully is going to be a long-term one, not just for yourself, but potentially for other family members too as well, because a lot of these are connected. Then there's the plan. What plan do you have in place? What's your required rate of return? What do you need? how much liquidity do you have within that plan? So if something happens, both foreseen or unforeseen, you know, is that taken into account? So you don't have to gut your retirement plan or your plan for your kids' education going forward. And the last one is the investments. This is the one that you can't control. And this is unfortunately where all the volatility comes from. So how do we best deal with those? You know, we've dealt with those three areas that we can control as investors, both in good markets and bad markets. How do we deal with this volatility going forward? What's the best way to look at it? Well, the first thing to do is really look at what volatility is. Now, volatility within the is essentially just a fancy word that we like to use in the investment industry for risk, right? And risk is really quantified, and there's standards to how it's quantified, and that's done by the Canadian Securities Administrators. So, you know, and what they've done is assign numbers to it. So essentially, anything that's less than 6 is low risk. Anything greater than 20 is high risk, and then variations that happen between that. So this is something that we look at when we help clients construct portfolios for whatever their goals are. We look at the risk and those areas of risk that that are indicated there as well. Now, the other thing about volatility or risk, and I'm going to use those terms interchangeably here, is risk because of it's really the opposite of predictability. When things, you know, if there's an old saying in this business where people say, I don't know where the markets may necessarily go over the next 12 months, but I'm fairly confident to know in which direction the markets are going to go over the next 12 years. And historically, if we look at the numbers, and if we look at rate of returns, and especially done looking at the US stock index, so the 500 largest companies that trade in the United States, as time progresses, that volatility decreases because there's more predictability that's over time. And so really, if we're looking at investing for the long term, those short-term fluctuations in the market should not be a huge concern. They should still be looked at and reviewed, but they shouldn't be the basis for your entire decision-making, especially if you're investing for the long term. So looking at, you know, standard deviation, and standard deviation is just a fancy word that's essentially basically says, what are your possible rates of return? And it's a mathematically derived number. So if we're looking at a low risk investment that has a rate of return of, as you can see there, each investment starts with $1,000 and has, you know, variable rates of return over time. So over a 3-year period, the annualized rates of return you'll see will change, but that standard deviation will vary. So in any given year, that rate of return may vary by 2.16%. So let's say on year one, on the first investment that shows an annualized return of 5.4%, that could be in any given year either 7.56% or 3.24%. So that's how standard deviation works, the likelihood of returns over a period of time. So if we're looking at a higher risk investment, naturally that standard deviation number is going to be higher. That likelihood of returns, that range of returns is going to be higher. So with a standard deviation of 20.96% in any given year, let's say the first year where the annualized return was 16.7, that could range anywhere as high as you can see 37.66 to as low as minus, I can't do the math in my head here, but just north of 3%. So the more risk that's involved, the more that range of possible returns can be over a short period of time. So if we look at the mutual fund investor here, these are the types of funds that fall within those ranges that we discussed in the previous slide. Very low are usually money market type of instruments, low or fixed income, so some generally bond instruments, low to medium or target date funds, some balance funds, even some fixed income funds. And if we go to higher categories, we see dividend funds, international equity funds, and then as we can see, the higher the risk or potential volatility, the more specific those funds are. So you're looking at specific geographic locations, specific targeted type of funds, and pretty much all alternative funds. So what are called hedge funds and that sort of thing fall within the high group itself. What you'll probably also notice too here as well is a fund category or a type of fund can be in two different places. That depends more on the management style of the manager of the fund, as well as certainly the geographic location as well. So it's something that one really has to examine more in depth. And with over 6,000 funds in Canada right now, that's a daunting task. But this is something that we help members with all the time. And I would also say that investments such as exchange traded funds or ETFs probably fall within the same categories too as well. So that would be a decent rule of thumb to use as well. So when building one's portfolio, everyone is familiar with looking at stocks, bonds, and cash, or equities, income, and cash. So equities are generally the higher risk investments, and cash is the lower risk investments. And anyone who's been investing for any period of time kind of knows this already. Really, when you build your portfolio, you're going to want a combination of all three, depending on what your goals are, right? Cash is more for short-term investments. Equities are more for long-term investments. So if we look at something really, specific here, according to FP Canada, which is the governing body for all certified financial planners in Canada, every year they come out with a benchmark range of returns for different asset categories. And that's usually based, well, now it's based on 52 years worth of data, where they look through all the data and they say, okay, what's the expected rate of return going forward for a client who's investing now over the long period of time. So they're looking at cash at 2.3% and savings in GICs, which we know is higher than that now on GICs, bonds at 2.8%, and then the range between either large cap or what people call blue chip dividend paying stocks and more speculative stocks. The range between that can be between 6.3 and 7.7%. So as we all know, securities all fell outside of those ranges, of course, at any given time. But the fact is, these are long-term expectations. So when we're constructing portfolios, these are the kind of numbers that we look at. So when we're looking at a portfolio of this, your traditional 60% equity and 40% income and cash portfolio, the weighted average of this, we're looking at something about 5.1%. And that's really the expected rate of return number if we're looking at an asset mix for a client of that nature, right? So, so that really helps in giving one a benchmark of which direction their portfolio is expected to perform. But as we know, in any given year, because of standard deviation, the volatility of that portfolio may change. So in any given year, based on historical numbers as well, that can be vary as much as almost 15% one way or another, right? But again, this is not a portfolio that anybody should be recommending to somebody for over 1 year or 2 year or even a 3-year time horizon. This is more of a longer term portfolio, 5, 6, and greater years that someone is looking at. Because as we saw in that early graph, that table with the S&P 500, as time progresses, volatility or standard deviation decreases. So diversifying a portfolio between asset classes is one way to deal with volatility, because you don't want to be all in all stocks if you don't need to be. And so certainly that's one way to do it. Another way to do it is rebalancing. And this comes down to the discipline aspect as an investor. So if you're looking at a portfolio with $100,000 and you go into this 60-40 type of mix we spoke about earlier on, and let's say the market changes. So let's say, you know, we're in a decent market over 1 year, the stocks increase by 12%, the bonds go down by decrease by $3,000, and cash increases by $200 over that period of time. All of a sudden that 60-40 changes from goes to 66-34, right? So if you want to rebalance the portfolio, which is what we always advocate clients doing, because that gets them the greatest chance of getting to where their goals or that required rate of return that we did for the plan initially, we encourage clients to rebalance at that time. And rebalancing, you know, kind of goes counterintuitively, because you're saying to yourself, why do I want to sell something that's going up in value, right? But we all know that that increase is not forever. So what we look at is we say, okay, well, let's you know, rebalance the portfolio. And what we're really doing is moving that excess equity portion into income or the bond portion, and moving some of that towards the cash portion as well. So what we're really doing here is doing what everybody's supposed to be doing when you invest, is you're selling high and buying low, right? But rather than using the market, rather than trying to pick the top of the price of selling high and buying low, you're basically using your portfolio percentage allocation to force you to do that. It's very difficult to predict peaks and troughs in the market, but by doing this is a way to get you into having a portfolio that doesn't become more risky than it initially was when you set it up. And by not doing this is why we see many clients who don't rebalance their portfolios wind up having larger losses when markets do decline, such in its periods right now, because that rebalancing wasn't done, or they never had an asset allocation benchmark to start with. So what I did now, the other thing you can do as well is dollar cost average to reduce risk. So again, I said it's difficult to predict when a stock or even an asset class is going to increase or decrease. So what I've done here is I've taken an example. And the only example I wanted to look at, I wanted to look at something that's kind of broad market-based. So I took the company PepsiCo. Pepsi, as we know, is one of the largest soft drink makers in the world, but they also own brands like Quaker Oats and other household goods that are out there as well that everyone's familiar with. So if we had a client or a member who was going in and buying, let's say, $1,000 a month, had excess money and they were going in and buying Pepsi, but they didn't know where the price was. Over the last year, well, not year, but let's say over the last, 11 months, this is what would have happened. From August 20th, 21, August 20th of 21 or 22, all the way back to September 20th of 21. So that should be 22, actually, all those numbers in this year. This is what they would have paid in the stock. And so what you see is, although they purchase a number of shares, they wind up acquiring 72, just north of 72 shares, and their average price is 166, and their average cost is a little bit less than that, right? So if we look at it from a graphical point of view, this is what's happened. We've seen the volatility of Pepsi and the blue line there that goes up and down. And who knows when the right time is to buy or sell given that. So what they've done is they've just said, okay, we're going to dollar cost average and we're going to buy the same amount. We're going to spend the same amount of money on the same day of every month. So what's happened is we've had an average price and an average cost that now is that we can see is significantly lower than what the market price was back on that date. So dollar cost averaging, as you can see, smooths out those bumps, but it also allows you to participate in the increase of a share. Now, I've only done this for one share, but this applies equally to mutual funds as well, and of various kinds. So it's also something that one can look at as well. We have many members that do monthly pre-authorized contributions into their portfolios, especially in the case where it's a popular strategy for to supplement retirement savings, either through a TFSA or a non-registered account, or for a child's education through an RESP. But the forgotten diversification, we've looked at asset classes, stocks, bonds, and cash, and we've looked at, diversifying by, figuring out when you're going to purchase. But the forgotten diversification is also geographic, sector, bond type, and management style. And that management style is most important, and the style of fund is very important when it comes to mutual funds or ETFs. So these are the kinds of things, again, that we look at when we construct portfolios for clients. We look at portfolios and this management style of their funds, of their ETFs, to ensure that really they're not overweight in one style, because one style doesn't necessarily run as the best and the least risk adverse style at any given time. So, in different markets require different management styles. So that's something that we look at too as well to diversify for clients. Now, you've probably seen this, people have probably been saying this for the last 30 years, that asset allocation determines 90% of portfolio performance. What we're here to tell you is it's not true. You've been misled for the last 30 years. Really, asset allocation is only part of what determines the portfolio performance. And if we look at it, and this really came from a study, a misquoted study that was done by back in the mid-1990s, where they looked at portfolios, essentially U.S. private pension plans over the prior 11 years, and they looked at security selections, timing of transactions, and investment objectives and policies. And for a lot of people in this industry, unfortunately, they just said, well, the determinant was 90% is due to asset allocation. The reality is, from the study itself, investment policy accounted for about 93.6%. And policy is a combination of asset allocation plus those other factors that we spoke about earlier in the presentation. Policy and timing accounted for 95.3%. So if we look at dollar cost averaging, that has a greater impact on your portfolio. Policy and selection, so looking at the style of funds, and the management style, and also the manager themselves, accounts for about 97.8%. So really all the things that you can control pretty much as an investor, and if you're working with an advisor, about 97.8% you can control on the growth of the returns of that portfolio. The only thing you can't control is the other 2.2%, and that's the market volatility, right? So really looking at investment policy is the first place to start. And that's the thing that we sit down with clients. So when looking at investment policy, we're looking at future income objectives, time horizon, target risk levels. So what level of risk that you're comfortable with, or volatility? What's the rate of return that you need to meet those objectives? And then we look at the asset mix that you're in right now, and at what sort of place are we going to rebalance those portfolios going forward? So how does one develop an investment policy? This is a new term. Well, a lot of people refer to it as a financial plan, but a financial plan is only a small part of that. Certainly, you want to sit down with your family members and look at make an appointment with one of our advisors here at Rapport Wealth. And we're here to really help you kind of guide to that. We'd sit down with you and we take an enormous amount of notes because we ask questions that maybe you may not have think of, but we or other advisors have not asked you, but are relevant to one's portfolio. And then we take all that information down and we basically construct a plan, a written document that's meant for you that we present to you as a roadmap, as a game plan for dealing with volatility through your portfolios, both in good markets and bad markets. And no portfolio and no game plan is fixed in time. It's important, as we saw early in the presentation, to do regular reviews. So we've covered a lot of material here, but we've done it at a very high level because everyone's situation is different. But there are a lot of resources out there that you can look into is if you want to get more information. Certainly myself or one of my colleagues is a great place to start. So a wealth advisor here at Rapport Credit Union. Or if not, if you're dealing with a planner somewhere else, you want to make sure that that person is a certified financial planner as well. Somebody who really understands all the aspects of financial planning, not just investing in the markets, because as we can see, there's a lot more components in investing than just what security selection is out there. If you're working with an accountant or a lawyer, it's important to have them in the loop too as well. And if you want to go online, there's a number of resources that are available there too, through FP Canada, through FSRA, Ontario Securities Commission. If you want to see if your advisor is registered, you do the national registration search. Investor Education Fund, Get Smart About Money, is a great site to educate oneself. Also, Financial Consumer Agency of Canada, not so much on the investing side, but also on other things too as well. If you're looking at insurance or credit or what scams there are out there even as well. And if you want to get information about your personal circumstances, so let's say you want to find out what your pension, your CPP or OAS potentially will be, Service Canada is also a great place to look at as well. Now with that, if anyone has any questions now or in the future, certainly you can also always reach us at wealth@rapport.ca as well, because we can certainly direct you to a situation that may make sense for you. Now I see that we have some questions on there already. And we can certainly address those too as well. So the first one that we had here within the presentation, it says, thanks for the information on the tax of a GIC, but isn't the name of the game in this era is to keep your principal instead of markets chewing it up? Absolutely. Absolutely. But the thing is, as we saw, it's not just the markets that are chewing up your portfolio and taxes, but it's also inflation too as well. You want to be able to maintain your purchasing power. So sometimes that may entail you maybe having a little bit more in fixed income or a GIC rather than less. But again, it's hard to say given anyone's particular circumstances, because when you're trying to jump in and out of the market buying a GIC, you're also timing the market too as well, which is very, it's a very difficult thing to do. Financial professionals can't do it. And people have said they can't. It's been proven time and time again. So it's not so much of getting out of the market, it's when to get back in. And that's the key thing. But that is a great question though, too, as well. The next question on there is, hello, I may have missed it. For volatility timeframes, have you calculated the worst era in the last 40 years and map out what the current scenario would look like relative to that? We're now looking at what happened 40 years ago. Comments, thank you. Yeah, well, anytime we do a financial plan for a client, we always take that into consideration. We do what's called a Monte Carlo analysis, and that basically takes actually we go a little bit longer, we go about 50 years worth of data, and we look at the worst era and how that portfolio we're recommending, that asset mix that we're recommending would have performed over that period of time. We really don't focus too much on the upside because we know the upside is pretty much given. And we don't look at how much excess upside that you're going to get. We look at what's the potential downside and what's the maximum downside here, because we all know markets do decrease. It's a moving target and we want to plan for that with our members' financial plans. So we do look at those numbers too as well. Do we get presentation materials? Well, we can send out this presentation, a hard copy to you, or a soft copy rather, electronically. We've done this in the past. We'd be more than happy to do that too as well. And we will send that to everybody who's on the presentation as well. Can you cost out the dollar cost average over a longer time horizon? Yeah, absolutely. That captures our situation today, the worst in 40 years. Good to see the value of principal over time. Yeah, absolutely. And I can tell you over longer periods of time, that dollar cost average number actually looks better rather than worse. But certainly we can do that. And that's, again, we do that for clients within their plans that we construct for them. We look at what that dollar cost averaging versus the one-time purchasing looks at going forward. Next question here. Large bank receive 10% of portfolio should be in equity, also to invest in 5 years versus 3 years. Yeah, it depends on the client themselves. It depends on what your objectives are. See, the one thing is what we shy away from is we shy away from kind of fitting clients into boxes, like pigeonholing them. They're saying, okay, well, you're in this age category, or you're, so you should be here. A lot of banks, the marketing material that comes out is essentially that it gives one situation. And it illustrates that. So we try not to pigeonhole people, and we don't really try to predict the markets. We try to use history and as a best predictor for where markets most likely will be going forward, and also what the required rate of return is for a client to get it there as well. Next question is, lastly, they say invest in for risk chicken. That's me. Put money in market-linked GICs because you are in the market with principal guarantee. That's always an opportunity as well. And that may work for clients that either for a large portion or a small portion, or for none of their portfolio as well. It depends on what your goals are. If you're looking at potentially participating in market returns and you don't have a set time for that money, and that money is not, you don't have any need for liquidity in that money, then that may be a solution that makes sense. But not all market risk GICs, I should tell you, are created equally. Some have participation limits, and it's important to look at those before you commit your money, because once you're in them, you're in them. You can't get out until they mature, and no matter what happens in the markets. Next question is, what is the benefit between less than a year GIC and 1 or 2 year GIC? I hope to go back into the markets of the future. Well, it depends. That's a difficult question to ask because, again, you have to determine what your reason for getting into that GIC is in the first place. If you're looking at capital preservation, then you're going to say, okay, well, what's my rate of return that I'm getting on this GIC versus the potential risk of being in the market now? And am I putting all of my portfolio in that GIC or part of it? So, it's a difficult question to ask specifically, but it depends on the client, and it depends on the member and what they're looking at. Where do fees come in from all of this? That's a great question. We are non-commissioned advisors at Rapport. We do not make any commission off of any recommendations that we make to clients. So if we're looking at a client's portfolio and their best place is to be all in cash, or the best place advice that we can tell them is, spend half your portfolio now, or whatever advice it is, or go entirely into stocks, it doesn't make a difference to us on our compensation. We're salaried employees. So fees do not factor into any decision that we make. I should say, though, there are portfolios that can be offered. We can offer them on a fee-based basis. And there are some benefits to doing that, especially on the client themselves. And that depends on the situation. But we would always, anytime we present that sort of situation to a client, we always give them, their options. So they make an informed decision with both eyes open on what they want to, they're looking at doing. My portfolio has dropped 10% since January 2022. I'm wondering how low it can go. Well, that's a great question. And I think I would encourage you to have a conversation either with the advisor you're dealing with right now, or if you're not dealing with a rapport advisor, come in and reach out to us through wealth at rapportcu.ca. And we'd be more than happy to have that discussion with you. It's hard to say, not knowing what one's portfolio is invested in, to give an idea of how much volatility is in there, right? Can you break out of a GIC before maturity with penalties? It depends. Most of the time, no. But there can be some flexibility. I would say go to the institution that you have the GIC with, and speak to one of the representatives there, and they will tell you all the terms on that GIC. Lots of times, if you can break out of it, it's very restricted. If you can, and the penalties sometimes can be significant. But I've seen institutions where they've made it less penalized. So it depends on the GIC issuer and the institution. So I'm sorry I don't have a more exact answer for that. That's it for the written questions. Are there any verbal questions out there? Did anybody want to come on the line and ask a question? Okay, well, we are approaching 12. We will be available for questions, and certainly if you have a more specific situation that maybe you're not comfortable in asking online here, or you're looking at you have something more specific to your situation, please do not hesitate to contact us. We're always available to have that dialogue with our members, and even people who are not members who may want to be a member. It's certainly something that we believe in, that we're here to be your greatest advocate for your financial well-being. And certainly we would be more than happy to have that conversation. And what we will do is we'll also forward this presentation out, so you have our contact information too as well. So you'll have our contact information, not just now, but in the future as well. And on that, I'll thank everybody for joining today. I hope you were able to get some good strategies out of this. If you want to implement these strategies more specifically to your situation, again, we're here to chat. But the basic thing I'd like you to take away today is there are things that you can do to control your financial well-being, to be like that lab, and to be kind of to know that you're confident, and this volatility has been factored into your financial strategy, and that you're going to come out hitting your goals, and on the other side being okay. I really enjoyed presenting today. Thank you very much. And we will be doing these in the future. We may reach out to you to see if there's any specific topics that you might like us to cover in a online presentation going forward. And certainly we're available for one-on-one conversations. Thanks again for attending, and I wish you all the best for the rest of your Wednesday afternoon.